Good evening, everyone. I hope my voice is audible to all of you. May I get a quick confirmation over the YouTube chat box? Am I audible to you? Well, okay. That's great. So, welcome you all to the AAA Grand Revision, guys. This is our Advanced Audit and Assurance Grand Revision for June 2025. So this is what we are going to discuss today. Everything, literally everything about advanced audit and assurance. So we will discuss the important theory areas. We will discuss the concepts, not the application, but yes, the concepts will be discussed in this session. So please sit back straight and listen to this particular session until the end so that you get the confidence. Yesterday, so many of the students have got their confidence from SBR Grand Revision. So now it's time for AAA Grand Revision. So let us first discuss the format of our exam. Now, a student preparing for AA can also utilize this for certain areas. So first I will discuss the format of the paper. It is for 100 marks, we all know. So question number 1, we are going to get from either audit risk, or there will be a risk of material misstatement. There can be business risk as well. Yes, and here we will talk about various IFRSs as well. So of course, there will be risks associated with revenue, leases, financial instruments, group accounts. So you can find group audit here as well. So that's what is tested. And if you remember, there is a new type of requirement, in audit risk, where they ask you that why a particular risk. So for example, why revenue is a risk of material misstatement. So this is a very specific question that they have asked. So maybe for 6 marks or 8 marks, they would ask you directly why revenue is ROMM, or why, anything else like inventory is ROMM. So they're not asking you to identify the risk of material misstatement. Rather, they're giving you one risk and asking why it is a risk. So that's a new kind of requirement. Plus, you should be aware about the materiality calculations, because of course, materiality calculation is something which is very important in risk questions. So you have to tell why why the materiality is kept at a lower or a higher level. So based on that, we have to decide, whether the risk of the business is very high, then the materiality will be lower. If the risk is less, then the materiality can be higher. So based on the case study, you have to decide whether you're keeping the materiality at the lower threshold or the higher threshold. So that's the question number 1. Then we have question number 2, which usually tests you on something like matters to be considered. So in the Super 20 series of AAA, this time we have actually done so many questions which talk about matters to be considered. And along with that, they also talk about evidence that you might find related to that particular topic in the audit working file. So that's what question number 2 asks you about. It can also ask you something about procedures as well, right? And this is for 25 marks. And the question number 1 was worth 50 marks. So 50 marks is a huge chunk of score which is vested in question number 1, right? Then we have question number 3. So this question number 3 is again 25 marker. Usually it is coming from review and reporting, where they might ask you to critically appraise audit report. They can ask you something from other assignments. And recently they have been testing you on sustainable reporting as well. So sustainable reporting is also something that is coming up these days from the perspective of an auditor. So today we will see a question on it. In a recent past paper, we will see a question on it, and we'll see how to decode it, right? So I have covered this concept with my students in the classes, but again, I will discuss the application part of it towards the end of the grand revision. So this is what my format of the exam looks like. Okay. Now that means there is no such topic which I can believe that, okay, this is not going to come up, or this is not something that, is not important. Let's leave it. So there's no such thing that you can leave. You have to literally do everything. So there's no option of leaving something. Correct? So that's very important for you to understand. Okay. Now let's start with direct theory questions, like what can be asked to you. So first and foremost, in our direct theory questions, you could be asked upon, what is ISQM1? What is ISQM1? So ISQM1 talks about the quality management. There can also be a requirement in question number 2 or 3, where they ask you to comment on the quality of the audit or talk about professional issues. They are also somehow related to ISQM1 only. So ISQM1 is a standard which talks about that how auditors should maintain the quality of his audit. So see, you should know that audit is a process which is based on judgments, correct? It's like, you can't say that this is tick the box approach, or this is like, okay, we have to do this in, we have to go left, so we are going left. No, it's not factual. It's based on judgment. We apply professional skepticism. That is also based on judgment, on experience, right? So it is based on judgment and application of professional skepticism. So that's the first most thing, that our audit is based upon judgment and professional skepticism. So when we apply these two things, what comes in? So you can say by application of above principles, the problem of relativity arises. Problem of relativity arises. Now, what do you mean by relativity? That's basically that the concept or the way we think is relative. What I think is different, what you think is different. So we have different perspectives. So it is subjective, it is relative. So every auditor is going to think in a different way in the same circumstances. That's what judgment and skepticism has a feature. So now, with this problem, we have to make sure, it is to be made sure that given the subjectivity and complexity of audit must be qualitative at all times. So not just with one auditor, it should be, qualitative, even if the audit engagement partner changes, even if the client changes. So whatever is the circumstance, I have to maintain the quality of audit. So for that reason, what we have is, we have a proper system of quality management, right? So we have ISQM1, which suggests a proper system of quality management. Now, this quality management has certain standards. Okay, so there is a standard on quality management. So I will discuss 8 elements of it. So you should remember this or memorize this as it is. It can be actually asked as a direct question, in fact. So make sure you memorize it. So first thing is firm's risk assessment process. So number 1 is firm's risk assessment process. Now, which firm are we talking about here? We are talking about the firm of audit. The auditor's firm, because who is supposed to maintain the quality? The client? No, it's the auditor who is to maintain the quality. So the auditor firm should have some kind of risk assessment process where they must analyze the size, environment, and specific situation. And this risk assessment process must be ongoing. That means you're not checking the risk of your clients and yourself just for once. You're doing it as an ongoing process. So in the firm risk assessment process, we basically talk about the audit firm having risk assessment procedures in place, which are designed and implemented in a very, decent way to identify risk. So they're designed and implemented to identify risk, right? So we must consider the firm's size. We must consider the audit firm size, environment, specific situation, networks, and external service providers. So I should actually be considering as an auditor all these stuff before I take on any client or I go on any audit. I should consider the size of my firm. Am I able to take up that client? What is my environment? Am I able to deal with such a client? What is my specific situation? Maybe I'm dealing with some financial problem, so I should not take up a client which is not going to give me good amount of returns. Networks and external service providers. And I should consider all these random factors in an ongoing way. So the ongoing risk assessment must be there. So ongoing risk assessment must be there. So you should not do it just for once. You have to keep on doing it so that even if like I started or conducted risk assessment procedures in the start of the month, but there was no risk. So I will also do it. I will also do it at the end of the month or during the month, and I'll keep a check on it. So maybe it was not there before, it's there now. So that's ongoing process. Second, to maintain the quality, they talk something about governance and leadership. So you all must know that the culture at the top, or the owner or the governance at top, they are setting the tone of the company. So we can say the top management or governance, top management or leadership sets the tone of an entity. So tone of the entity is set by the top management. If the top management is prioritizing clients, like they're prioritizing the fact that how many clients are paying fee to us, and they're not prioritizing the quality of audit and ethics, then the whole firm will be like this. So the top management has to be following integrity, objectivity, and being ethically right at all times. Then only the whole firm can follow that. So, the firm should demonstrate a commitment to quality, through its culture, and recognize its role in serving public interest. So we should be at the top of the management, be focused on the public and do the all righteous things. Then only the whole firm can follow that culture, right? Okay. Then the third thing within this, what else can we write? How can we have a tone at the top? We can say the CEO and the chairman, the CEO, the CFO, the chairman of audit firm must prioritize quality of audit and ethics over self-interest and financial gains. then only the whole firm will follow that, right? So if this will happen, if such a culture will be there, the audit team members would be able to challenge, would be able to easily challenge the judgment of client. So basically, if you as an audit team member know that my manager is too much into not, stressing the client out so that he doesn't leave our audit firm, and he's too dependent on the client. So you won't try to offend the client, right? You will try that, okay, he remains pleased. So if the manager, the engagement partner, the tone at the top says that we don't care about the clients, we don't care how many people are offended from us, what we care about is quality. So if such a culture is set up that even the smallest members of the audit team will be able to challenge the audit client. So that's what we are saying. Governance and leadership should be qualitative as well. Then the third thing, most obvious thing, that the audit firm must follow relevant ethical requirements. So relevant ethical requirement means that whatever is applicable in that zone or in that jurisdiction, so we can go beyond the international standards on ethics. So we can go beyond IESBA ethical code, okay, based on jurisdiction. So if the jurisdiction of my client has more ethical standards, I will follow them as well, right? I should see whether all my associates, like any component auditor, for example, the valuer, they follow the ethics or not. I will train my employees for ethics. So train employees for ethics. That's how you can ensure good quality audit, right? So that's the third point. Fourth is, before we accept an engagement and continue a client, there should be certain procedures. So procedures related to acceptance and continuance of clients. So before you accept any client, you should make sure that you've checked their integrity. You've actually checked their existence. Their background check has been done. So, you have to assess their integrity of the client that you're taking up and the ethical values. For that, you can run a background check. You can do certain KYC procedures. You can talk to the previous auditor and stuff. Then you have to see for yourself as well. Do you have the knowledge, training, and experience to do the work for this client? And will you be able to apply ethics with this client? Like, if you accept this engagement, will you be able to behold your ethical principles? You will not compromise, or there will be no ethical threat. You have to consider all of that, right? Then the fifth point is engagement performance. Engagement performance. This is the major point where the whole crux lies. So on this, you get a lot of case studies as well. This is the application part. Engagement performance. So as an auditor, guys, I have to ensure a good quality audit, and audit is done in various stages. We direct the process of audit, we plan the process of audit, we supervise the process of audit. Yes, there is consultation required in the process of audit. There is review required at the process of audit. So all these stages should be qualitative. Now, see, what can be asked in the paper is all application based from this area. For example, I'm going to give you a few examples here from the case studies. The question says, the client requested or the client threatened the auditor to complete the audit within 2 weeks. Now, what can I say regarding this? Of course, this is intimidation threat, but this will also lead to bad quality audit. Why? Because you won't have the time to actually do the proper planning, direction, and supervision. So you will cut corners everywhere. Like, you will try to reduce your work so that you can complete it well in time. So this is going to hamper the quality of audit. Then another example can be, let's suppose they say there was no review by the audit engagement partner. No review by audit engagement partner. So we all know at the end of the audit, it is the engagement partner who reviews the work of the whole audit team. So this is also going to lead to bad quality audit. So how will you define it in your answer? You will first tell what is the importance of review, like why review is needed at all, because of course there can be risks of misstatements from the auditor as well. There can be certain detection risks. So we need the review from the engagement partner, and why it should be engagement partner only. Because of course, ma'am, he's the most important person in the hierarchy and he has all the independence and expertise. So he is the right person to conduct this review. After writing this, you will say, if this review is not conducted by the engagement partner, there is a risk that there are a lot of misstatements, or you can say material misstatements going unnoticed. So basically, this is going to increase your detection risk. So this will increase your detection risk, which will ultimately, of course, lead to bad quality audit. So this is how you're supposed to define that why it is bad quality audit. You're not just supposed to simply write it is bad quality. You have to define and explain why it is bad quality, right? Similarly, if the question says no planning meeting was held, so you'll tell why planning a meeting is important, because we understand the client, we assess the risky areas, we do the pestle analysis. Now, once we've identified all these things, in the planning meeting, we also allocate roles and responsibilities to the team members, right? And if that is not done, this will again lead to a very messy audit and a very cluttered audit, which is directionless. So that will lead to, again, bad quality of audit. So this is how you're supposed to explain in your exam that, there's a quality control problem. Then we have human resources as the sixth point. Human resources. So in human resources, it simply means that when you're conducting the audit, you should have apt workforce in timely manner. So as an auditor, it should not be like you do not have enough team members to conduct the audit. The client has expanded their business and they're becoming larger, but you do not have enough, capability to deal with that client. So you should have enough people with enough or compatible knowledge, training, and experience, and their seniority should be at apt level. So in the quality control problem, there is one more example. For example, the audit trainee, who is a part qualified accountant, was given the work of financial instruments. So we will say financial instruments are highly risky because of their inherent nature. They're very complex. So audit trainee is part qualified, so he lacks appropriate knowledge, training, and experience. So if a trainee has done work on such a risky area, this means there can be many misstatements which are unnoticed. So that's something which comes under this human resource point. Then communication and information. Communication and information. So what are we supposed to write here? Okay. So we are supposed to say that anything which we are obtaining, generating, or using as an information, we should communicate it within the firm. We should communicate our policies to the personnel. We should communicate the information to TCWG of the client. We should communicate to component auditors. And we should also actually, keep a track of that communication. We should keep a record of that communication as well. So communication and information is that we should keep a regular touch with all the parties in the process of audit to maintain the quality. To maintain the quality of audit, right? So for example, it can be maintaining communication with the personnel, communication with the engagement quality reviewer, communication with component auditors or TCWG, whatever it is. Then lastly, we should keep on monitoring what is happening. So monitoring is also very important. So monitoring basically means that we should keep on checking the SOQM's effectiveness. So firms must put in place a process for monitoring the SOQM effectiveness and ensure deficiencies are identified in a timely manner, allowing for corrective measures to be implemented. This process is a continuous cycle which firms are specifically required to undertake. So if you have taken any quality control measures or quality management measures, make sure you keep a monitoring check on them that they are working well. And if there is any corrective measure required, you take it on a timely manner so that the quality is sustained. So this is what we have as 8 elements of ISQM1, which can be asked in form of application in the question number 2, or it can be a direct 7 to 8 marker question. Are we guys clear on this concept? Yes, are we all clear on this? Okay. Let's go on. Let's move to the next theory questions. Let's understand a very common concept which is asked. That's our second topic for the day. NOCLAR. So what can be asked from NOCLAR? NOCLAR is basically non-compliance with laws and regulation. So we have a proper ISA on it, like who is responsible for non-compliance and what should be the further procedures or the same. See, first of all, every company has certain laws and regulation to follow. If our client is not following the laws and regulation, it's their fault, not ours. So first of all, management has the primary responsibility. Management has the primary responsibility for compliance with laws and regulations. So management has the primary responsibility for this particular thing. Now, what does the auditor do for non-compliance then? See, auditor is responsible only for one law and regulation. That is the law and regulation which impacts the financial statements directly. So if there's any such law and regulation, then only the auditor is responsible for it. So auditor in general has to maintain skepticism. Okay, that's his job, to identify any NOCLAR. So he should know that, okay, which laws and regulations are applicable to my client. And in general, he should be skeptical to see whether there is any NOCLAR or not. So for that, he can even do pestle analysis under ISA 315, where he can actually understand the environment of the client, the laws and regulation which are applicable, which the client might know or might not know, right? Now, what happens if the auditor actually identifies a NOCLAR? So if a NOCLAR is identified or suspected, then the auditor is supposed to gather evidence regarding the nature and circumstances of the event and how does it impact the financial statement. So if in case the NOCLAR happens, then the auditor is supposed to gather evidence regarding the nature and circumstances of the event. Okay, so that's the first thing. And then tell that how does it impact the financial statement. This is what the auditor is supposed to do if any NOCLAR is identified. Then if we have identified a NOCLAR as an auditor, to whom should we report? Whom to report? NOCLAR. See, first of all, you should report it to those charged with governance. There is a possibility that the client's governance does not know that there was a non-compliance. But if you think they have done this on purpose, we can actually disclose it to authorities as well. So we can also disclose it to third parties or authorities. But for that, we can, first take a legal advice that is it right to disclose to third parties, because it might breach the confidentiality. So if it is in public interest, I believe you can disclose. Otherwise, you're not supposed to disclose. So this is what we do for NOCLAR. So if there's any law and regulation which directly impacts the financial statement, if there's any such NOCLAR which directly impacts the financial statement, then as an auditor, we must gather sufficient and appropriate audit evidence, okay, that yes, there was no NOCLAR related to such laws and regulation. But if something was indirectly impacting the financial statement, okay, if there's any such law which indirectly impacts the financial statement, for that, we have to maintain skepticism. Yes, we have to maintain skepticism, so that if there's any such NOCLAR, we can actually, blow the whistle and be like, oh, we found the non-compliance. So that's the concept of NOCLAR. Then we have another concept, I would say another direct theory question, which is fraud. So question number 3, let's talk about fraud or auditor's responsibilities regarding fraud. Okay. So for this, what we have is we need to first understand what is fraud. So there can be a fraudulent reporting. Okay. There are two types of fraud. One is window dressing, which is known as fraudulent reporting, where you purposely post incorrect journal entries or you overstate. Incorrect journals are posted, or you overstate or inflate few things. You inflate. So you inflate the profits or losses, right? So that's window dressing. And another fraud is misappropriation of assets. Misappropriation of assets. So for example, you steal something from your company. So that means as an auditor or within our clients corporate, they can steal the assets of the client. So the employees can steal the assets of the company for their own purpose. For example, you're given a car for certain business meetings, but you end up using it for your personal functions at home. So you're using it inappropriately, misappropriation of assets. Or there is, like, for example, any theft. So this is misappropriation of assets, or two kinds of fraud which exist. Now, who has the responsibility of this? That's a very valid question. Who is responsible for it? So can you tell me, is the management responsible or the auditor? Of course, it's the management who has the responsibility of fraud. Auditor comes after the year end has happened, right? So we are supposed to just work on the client after the year is over. So management has the primary responsibility throughout the year to figure out the fraud possibilities. It's not the auditor. So management has the primary responsibility for prevention and detection of fraud. So that's one thing. Second, auditor in all good circumstances, might not be able to detect the fraud, even if auditor works to his best possible quality, because nature of fraud is such that the preparator of fraud wants to conceal it. So see, when someone has conducted a fraud, or for that matter of fact, a crime, they would like to conceal it. They don't want anyone to figure out that they have conducted the crime. So similarly, the fraudster must have tried to hide the evidences, and auditor comes towards the end of the financial year. So it's very difficult for him to find the fraud, right? Because he's not there throughout the year. And of course, the nature of fraud is such that the evidence is hidden. So it's very rare that the auditor will be able to find a fraud. And even if the auditor has a doubt that yes, there is some kind of fraud happening, the evidence that he might gather, or the evidence that might be suggestive, is persuasive in nature. It's persuasive in nature and not conclusive. So the evidence, it just suggests that, okay, this can be the fraudster, or actually the fraud has happened, but it does not give you a proper kind of guarantee that, yes, this is something which is the scenario. So it's like you just collect clues that this might have happened, but you don't get the 100% right information. So the evidence will be persuasive in nature and not conclusive, which increases the further chance that, yes, we won't be able to find fraud. Then auditor does not perform procedure on 100% of the areas. Of course, it's done on sampling basis, as substantive testing or substantive procedures are performed on material heads, and on that too, sampling methods could be used, which suggests that detecting fraud is very challenging for the auditor, right? Because he's not even doing work on all the transactions, he's just doing it on sample basis. So we are just telling that how it's very difficult for the auditor to detect fraud. Then all that auditor can do to detect fraud is to just maintain professional skepticism throughout the process of audit. And making inquiries in case there is any contradiction in evidences collected. So if any evidence is like, going against the other evidence, so evidence 1 suggests that revenue has increased, and evidence 2 suggests revenue has decreased. So they're contradictory. So on that, you should make proper inquiries and satisfy your question on that and do a proper investigation. That's what you can do as an auditor. So if the management is involved in the fraud, it is further difficult to detect fraud, right? So what we can say is, overall, auditor is responsible to identify the risk of material misstatement, due to fraud. So if auditor has lacked his duty of care. So you all know that in ethics, we have professional competence and duty of care. So it's auditor's duty of care to actually do the testing and conducting the procedures. So if auditor has lacked his duty of care to perform substantive procedures on a risky / material area, then yes, up to certain extent, auditor is responsible for the fraud. So that's what we can say. That, see, Auditor is not liable to find if there's any fraud that is happening. He's not responsible for the detection of fraud or avoidance of fraud. But if he figure out that, yes, there's a fraud, he must take action on it. But if he's not performing his work or his testing in detail, so maybe he's missing out on certain material misstatements which are due to fraud. So that is something for which we can hold him responsible. And that too will be it will be an auditor's liability, but a civil liability, not a criminal liability, right? So that's what we have for fraud. So these are the direct theory questions on fraud, then NOCLAR, and then ISQM 1, which are given as chapters in your syllabus. But I am again covering the gist of it, that if you get a direct theory question on it, what you can write. Now, on that note, let's go and understand, as we said, the auditor might be liable for certain things. How can the auditor limit his liability? To understand the limiting of liability, we need to first understand what kind of liabilities are there. So we have fourth topic, where we talk about professional liability. Professional liability. So professional liability is like because of negligence, so tort of negligence. So if auditor was unable to do the proper workings and perform work on the client's financial statements, and due to him the audit report is incorrect, then he might have to face the you can say consequences. So which will give rise to civil liability. It's not a criminal liability, it's a civil liability. So if you want to sue the auditor because you think he has not performed well, you must make sure that duty of care existed. So in that particular arrangement or agreement between you and the auditor, the duty of care must have been existing. So for example, auditor, does he have the duty of care towards public? Yes, because he's signing an audit report. Who is using the audit report? The public. They look at the audit report of a company, and based on that, they would invest in that company. So he does have a duty of care. So duty of care, first of all, must exist. Secondly, there should be a proven breach of duty of care. In that particular situation, there should be a proven breach of duty of care. Maybe you were involved as an auditor in fraud, or you concealed the fraud, or you conducted a bad quality audit because you were negligent. Then another thing should be there, that this must have led to a financial loss to the counterparty, which can be quantified. So if someone is suing out of public, someone is suing the auditor of Reliance, they should be able to justify that what loss the auditor has done to them. Maybe they invested in wrong stocks, which has given a loss to them, or you went into the investment and your share value has dropped because of that fraud. So that is something that has to exist. So all these three conditions must exist before you say that there is a professional liability. And on that, we also come to a question that how can auditor dodge it? How can auditor dodge / limit his liability? How can he limit his liability? Because then every person who sees the share price falling will start on suing the auditor only, that I trusted your financial statements and the share price has decreased. So how can you limit the responsibility? As an auditor, first of all, you should make sure that you're not accepting irrelevant clients, right? So you are accepting clients which are ethical, who are not involved in frauds, who are not having a bad history. So you should have proper acceptance procedures, first of all. That's the first and the foremost thing. Second, you should do proper documentation. For example, at least for 5 years, you should maintain the records. That if you have done work for any client, they can sue you anytime. So make sure that you have all the audit working papers for the next 5 to 6 years with you. So in case there's any court proceeding, you have documentation with you. Then there should be a disclaimer of liability paragraph in the audit report, where in the engagement letter and the audit report, you mention that my liability is just capped at this amount, or I am not responsible for this particular issue, or this audit report is just for the existing investors. It is not for potential investors. So all these things can be treated as disclaimer of liability. Then you can cap the financial loss, that even if someone sues you and you're proven guilty, in your engagement letter and audit report you've mentioned that if this happens, my financial loss will be just 10% of my audit fee. So they can't take my house and my assets in the name of suing me. So I will limit it, that this is going to be capped at this amount. Then there should be, like, you should create a limited liability partnership. So even if someone sues you, you actually just have, you just have to bear your own like company's loss, but your own assets are not at stake. So you have a limited liability in that partnership. Then you can use engagement letter, use of engagement letter. So in this, you properly set up the scope of what is to be done in the process of audit. When are the communications going to happen? Who's going to be the reader of the audit report? So all these things are listed there in the engagement letter. The scope, the timing, the direction of audit, the fee of audit, what are your responsibilities? Everything is stated in the engagement letter. So that's how you can limit the auditor's liability. Correct? So these are again 4 important topics from where you can expect a direct theory question. Now before I take a short break, let me discuss briefly with you, like, what is the process of audit looks like. So first step is step number 1, where we actually accept a client. Okay. So first of all, we do a tender. So if as an auditor, I might make a tender to the client that, dear client, you are operating in this industry, and I'm also in the same industry since these many years, and I'm a experienced auditor. I can help you with the external and the internal or whatever audit you want to get done, and how I'm going to add value to you. So we put a tender in front of the client. Once the tender is accepted, we also accept the client. So acceptance procedure happen. So you are going to follow the acceptance procedures, like whether they have fulfilled your conditions, there's no ethical threat, the client has a clean past, okay, a good background, and integrity and ethics exist. So after that, you accept the client. Once the client is accepted, then we sign an engagement letter. So you should know what are the contents of engagement letter. So scope, timing, direction, fee and its basis. Then what are the responsibilities of the auditor? These are the contents of engagement letter. Once the engagement letter is signed, then step number 4 is to start the process of audit with planning. So in this, we conduct planning meetings. So we use ISA 315 and we conduct the planning meeting. Okay, so we do the analysis of the client and we assess the risky areas of that particular client. And we allocate the tasks to the audit team members. Then step number 5 is to actually conduct not just planning, but also, reviewing and conducting the work actually. So this is like the stage where you collect evidences, where you collect or you conduct procedures. Then step number 5 is to actually, step number 6 is to actually review what you have done. So every senior is going to review the work of the junior and see whether the evidence collected is appropriate or not. Then step number 7, you can actually do the reporting part to the users of audit reports. So maybe the general public, you issue an audit report, you sign an audit report. So these are the steps of the audit process. So what is tender. We've discussed on acceptance procedures. We've discussed on engagement letter. We will now discuss on planning, evidence review, reporting, and ethics, right? So this is what we have in our whole audit subject. So now, after a break of around 7 minutes, we are going to resume with the topic of ethics and then move on to planning, evidence, review, reporting, right? So let's take a small break of around 5 to 7 minutes and then get back to our grand revision. So break time. Yes, guys, I hope I'm audible to you. Let us resume with the session. Okay, so the next topic that we are supposed to discuss is ethics. Let's have a look at ethics. So first of all, you all should know that what are the 5 principles of ethics, right? Code of ethics give you the 5 principles against which you can have certain threats. So what are the principles of ethics? Let's just list them down. Principles of ethics. So we have PICOP, where P stands for professional behavior. Okay. I stands for integrity. C stands for confidentiality. Then objectivity. And then professional competence and due care. So what do you mean by professional behavior? Professional behavior is not bringing disrepute to the profession. That's basically having a professional behavior. So let's suppose you do not, use proper language in your communication with your clients. So that is something which is like you're bringing disrepute to the profession. Then integrity means being straightforward and honest. So you are supposed to be straightforward and honest as an auditor, right? You're not supposed to lie, basically. Then confidentiality means that I am not supposed to disclose. Confidentiality means not to disclose the information, financial information, or to disclose any information gathered in the process of or gathered in the business relationship without the consent of the client, unless required by law, or in public interest. So that's what I have to make sure, right? That I'm not disclosing the information that I gathered as an auditor unless it is required by law in court or it is in public interest. Objectivity means being unbiased, right? So you're not supposed to be just thinking about one set of people. So for example, if you just think about shareholders, like, potential shareholders, and you do not think about the other people like your employees, other stakeholders like banks, government. So you just think about shareholders and you want to increase the share price. So you are being biased towards one set of stakeholders. Then professional competence and due care means that you have apt level of knowledge, training, and experience, and you have that particular care in you. That how are you supposed to, deal with public interest issues. So for professional competence and due care is what we believe in CPD, continued professional development. That is why all the IFRSs, whenever they're revised, ACCA arranges for a webinar, and every person who's an ACCA affiliate or member attends that webinar and understands the updation in IFRSs. So that's what principle of ethics are. Now, there can be certain threats to the principles of ethics. So what can be those threats? For example, if I talk about a situation of conflict of interest, what is that situation? It's like you are an auditor of the competitor of your client as well. So for example, you are the auditor of the client and its competitor both. So now there is a risk, right, that you might leak out the information of your client to their competitor, which might give rise to confidentiality problems. So of course, if this happens, you are supposed to make sure that you have informed both the parties. So if you are auditing the competitor of your client, make sure that you have signed confidentiality agreements with both the parties. That means you have told the client that I'm auditing your competitor, and you've told the competitor also that I'm auditing the client. So now both of them know that you are the common point, and with both of them and their agreement, you have signed a confidentiality agreement which says that you will not disclose their information or leak out their information anywhere else. And you can also use separate teams to make sure that there is no leakage of information, right? So this is one situation of conflict of interest. Similar to that, there are so many threats like self-interest threat. So what is this self-interest threat? Here, basically what happens is there's a financial interest which is vested. So this financial interest which is vested is basically, for example, you own shares of your client. So you are the auditor of the client and you also own their shares. So you would want their share price to increase. So it's your self-interest, right? Then there is a threat of self-review. So this self-review is basically checking your own work. So you might have done some work and then you might end up checking your own work. For example, you might have been the internal auditor as well as the external auditor. So you've already worked on the implementation and, maintenance of the internal control. And then as an external auditor also, you're testing the controls. So that's a self-review threat. Then we have familiarity threat. Familiarity threat arises majorly because of certain long and personal relationships. So long association could lead to familiarity threat. Then personal close relationship can lead to familiarity threat. So basically you're giving favors, right? So you end up favoring someone in the familiarity threat. So if you say, ma'am, I know someone in, let's suppose I want to get an contact from ACCA team. And I say, I know someone in ACCA team, I can get the contact easily. So that's a familiarity favor that I've taken because I know that person, I can get the contact. So if there's a familiarity threat between the client and the auditor, then the client can get his work done on the basis of that relationship, right? Then intimidation threat. So intimidation threat is basically when you have actual or perceived pressure. So someone is actually threatening you or you are perceiving it. So actual or perceived pressure is there, due to which you are deteriorating the quality of your work. Then we have management threat. So management threat is basically where you get into the shoes of the management. So when we get into the shoes of the management, that means the work which management should have done, we start considering as auditors that it's our work. So it is like getting into the shoes of the management. So if you do that, of course, you will end up, you will end up taking on the responsibilities of the management. So that is what you're not supposed to do. And if management threat arises, then it cannot be reduced to a acceptably lower level with any safeguard. So for example, you start thinking that you are responsible for the design, implementation, and control or monitoring of the controls, and you are the one who are reviewing the controls. So that does not make sense, right? It's like you wrote your own assignment and you think you are able to check your own assignment. That's not possible. So management threat means you start doing the work which management is supposed to do, or you start thinking like the management. You become too attached to the client and you think like, okay, the client is my responsibility. So that cannot be reduced to an acceptably low level. Then we have advocacy threat. So advocacy threat is basically, you can simply say that you're promoting the client's interest. Promoting client's interest. For example, you might end up going to a bank meeting with the client so that they get a loan. So you will see so many circumstances in your paper where they would say that you are reviewing the going concern situation of your client, and you are requested to, accompany the client to the bank for getting a loan. So in that situation, you are actually acting as a guarantor. So bank might assume that you are the guarantor for the client, and that will also give you a legal responsibility to repay your client's loan. So advocacy threat arises in bank meetings where you're promoting client's interest, right? So these are the 5 ethical principles and major threats. Now let us understand, if a question is asked in the paper, there are various important scenarios, like gifts and hospitality is there, then temporary staff assignment is there, then you have scenarios of, for example, compensation on the basis of non-assurance services, fee dependence is there, overdue fee is there. So all these situations are existing in ethics, which I'm not going to revise. I suppose you can do that yourself. But let me discuss, if any such thing comes up, how are you supposed to write the answer? Or what is the best approach to answer ethical implications? So if there's a requirement which asks me about ethical implications, how am I supposed to answer it? See, first of all, I have to identify the threat. That's my first and foremost task. Identify the threat in that situation, whatever ethical threat is there. Then comment on why it is a threat. Why do you consider it is a threat? Because maybe, for example, you identified that the auditor is being threatened to do the work in 2 months. So you say it is intimidation threat. So that's your identification. Why it is a threat? Because if the auditor is being threatened, he will lose his integrity and objectivity, and he might end up doing wrong things in the audit or doing incorrect audit. So I am just commenting why it is a threat. Then I'm supposed to comment on its significance. Like, is that threat faced by a significant person? Like, which person is facing this threat? Is he a senior, a manager, engagement partner? Okay. Then if it is related to certain amount, then what is the size of that amount? Or, amount, is it material, like gifts and hospitality? Then is the client listed or is it unlisted? So usually for unlisted clients, all threats can be reduced to an acceptably low level. But for listed clients, it's very difficult, right? So you have to comment on the significance of the threat. And then lastly, you're supposed to give safeguards, that how can we reduce this threat to an acceptably low level? Like quality control review and separate team members can be used, right? So this is the best approach to answer your ethical scenarios. Now, if I talk about a very general situation, which is over and over again tested in AAA, it's about non-assurance services. Non-assurance services. So can an auditor who's, the auditing client provide other services like review, reporting, or, valuation services or IT services to the clients which he is auditing? If the client is listed, if the client is listed, see, if the client is listed, I cannot provide any such service. Okay. If that service is related to preparation of financial statements, I cannot provide such services. They are strictly prohibited under the code of ethics. But if the services are related to advisory, valuation, yes, if they are services, or valuation is also something which impacts financial statement. If they are like tax filing, not tax calculation, but tax filing, I can provide these services with safeguards. So anything which is related to financial statements, whether it is IT system related to financial statements or internal control related to financial statements or bookkeeping services, etc., I am not supposed to provide these services at all to listed clients. But to unlisted clients, I can provide these services, but this has to be done with safeguards. This has to be done with safeguards. Correct? So this is what we have in non-assurance services. So you have to keep all this in mind. In the exam, there will be a situation given to you that there is a self-interest threat arising. You will comment why it is a threat, what is the significance of threat, how can you reduce it, whether you should accept the engagement or not, whether you should withdraw from the engagement. And then, yeah, this is the best approach. And if you get any such question where we talk about non-assurance services, these are the rules for listed and unlisted clients. Are we clear on this? All of us? Yes? Clear on it? Okay. Let's move on. The next topic. Yes, money laundering. Let's talk about money laundering, which is again a direct theory question, very famous direct theory question. Money laundering. What do you mean by money laundering? So see, money laundering is a process of concealing the true origin of illicit funds. So it's a process. In simple words, it's a process of converting dirty money into clean money, right? So basically, you are trying to hide from where have you got those illegal funds, and you place that in the legal environment and you further layer it so that its true origin is totally untraceable. So what are the steps of laundering the money? Number one is placement. You first place the illegal funds into the legal environment, right? Second is layering. So what you do is you keep on making transactions from overseas bank accounts, and you keep on making small transactions here and there. So to layer that money. Then integration is finally actually you bring that into the real environment. So you finally bring the black money or the illegal money to the economy. So for example, you buy some luxury goods, you buy cars, you buy properties. So you're integrating the illegal money into the legal environment. Now, in the case study, there can be various indicators which suggests that this company might have a money laundering problem. What are these indicators? Indicator number one, that company is having a cash intensive business. There's a lot of cash involvement. They take cash payments. There are unusual big transactions, okay? Then there are small transfers to various bank accounts. There could be certain transfers to overseas bank account, specifically in the accounts of tax haven countries like, Cayman Islands, Thailand, Singapore, Hong Kong. So you might be sending the money in the tax haven countries. So this situation could exist. So if the indicators of laundering are existing, you are supposed to take certain measures. What are those certain measures? You could be asked a direct 5 marker. What does ACCA say against money laundering? So what are the policies by ACCA against money laundering? Let us understand. See, number one, every company should have an MLRO, appoint an MLRO. Who is an MLRO? He's a senior person, okay? He's a senior positioned person or senior member who prepares a report, okay? And what does he do in this report, which he prepares? He prepares a report on the basis of who is the suspect, okay? What is the nature of the event and what is the amount? So who is the suspect, nature and amount uh, of that particular money laundering that has happened, which you believe exists. So you see who's the possible suspect of it, what is the nature of this money laundering, and what was the amount involved. And this report is further given to enforcement agencies. So this is further given to enforcement agency, right? And this can be related to your particular country. Okay, so here we have a proper ED in India who works on money laundering. Then after appointing an MLRO, we also have to do KYC procedures. So as an auditor, we must have proper acceptance procedures where we make sure that our client has a clean background. Who is the owner of the client, with whether he's a politically exposed person or not. So we check the whole reputation and the risk profile of our client. And we also increase our records. So record keeping is very important, because if that person is involved in money laundering, sooner or later there will be a case or something like that, and you will end up being called up in the court. So you are supposed to be ready with your records. Then we should always communicate and train our employees in the entity. That's what ACCA says, that all the people from the ground level to the senior level should know that there is an MLRO to whom we are supposed to report suspicious transactions or events. And if we think there is something suspicious, we are not supposed to tip off. That means we are not supposed to make the preparator of money laundering aware that we doubt on him. Otherwise, he will conceal his actions. So make sure you communicate and train your employees. Then you should have such policies and procedures which are against money laundering. Okay, you should develop such policies, and you should keep on monitoring that of whatever processes that you've taken, like, you know, KYC, record keeping, policies, whether they are working fine or not. That's what ACCA says regarding your money laundering, that how can we combat the problem of money laundering, right? Are we clear on this? Okay, let's move on. Let's move on to the next theory topic, planning. So audit in the planning stage. Let us understand audit planning. Now see, in the planning part, you are supposed to first understand the client as per ISA 315. That means you do the pestle analysis, you see the political environment of your client, ecological environment, social environment, technological environment, economic environment, and legal environment. So you do the pestle analysis, then you figure out what are the risky areas of your client, okay? From the opening balances or from previous audit report, you check. Then you have a discussion, or you understand the nature of the business of your client, and you understand that, okay, these are the risky areas. So you identify the risky areas. You plan a response, that how are you going to work on those risky areas, and you allocate duties. So basically you set the scope, the timing, and the direction of audit. So you develop an audit strategy, right? That's what you do in the planning part of your audit. Now, when I talk about risky areas, I do not just identify the risky areas from the perspective of audit. I also identify the business risks. Because see, audit risk arise because there is some kind of self-interest. Why would someone overstate something? Because they are having a business risk. So let's suppose there's a debt covenant due to which they fear their going concern, which is a business risk. They might end up overstating their assets so that the debt covenant is not breached and they maintain their going concern status. So I have to see what are the business risks, and further I will develop and see what are the audit risks or risks of material misstatement, right? So I have to identify the risky areas of my client. Now, how to identify the business risk? How are we supposed to identify the businesses, or what are the famous business risks in a case study? See, number one, you can find a risk associated with the fact that there is loss of revenue. There's a decrease in demand, or there was a new competitor in the market. Yes. So when you're commenting on it, you will say, since there's a new competitor in the market, there's a possibility that people will go towards cost-effective ways, and people will substitute us and use the competitor instead, and we will lose revenue, which will further decrease our profitability and therefore our going concern. So all of this brings down us to the fact that this is a going concern problem, right? So you are overthinking that all risks associated with your business. Then related to loan, again, there can be a risk that the debt covenants are breached. So for example, gearing has to be maintained as a debt covenant. So if gearing increases, debt covenant might be breached. Also, with gearing, the cost of capital increases. Okay. So this will again lead to liquidity problems, because if the debt covenants are breached, so of course you might end up having no money with you. So liquidity problems, which will have going concern issues as well. Then there could be some issues regarding foreign expansion. So maybe the company is planning to expand in foreign or any other place, any marketplace. So the risk associated with it is, what if it fails? What if it fails? So just like you think before your exam, what if I fail? Same way, the business also thinks that we are thinking to expand, but what if we fail? So whatever cost we've incurred, we will end up getting nothing out of it. So that's a risk in itself. Then, for example, there could be compliance risk. So the compliance risk can lead to like your licenses are cancelled, bad reputation, legal claims, which can again impact your going concern. So such risks are being identified from the case study, right? So this is all case study specific. You can't be taught on it. There's no certain list of business risk. You have to identify it yourself. You have to think from the perspective of the client or the business, and as a manager, you know, like SBL approach has to be taken. You're thinking like a CFO here, that what all business risk my company is facing. Then we have audit risk. So audit risk, generally it's related to a standard. For example, there was a financial asset recognized during the year. So the risk is associated with IFRS 9. We've already discussed IFRSs in yesterday's SBR Grand Revision. So that is equally important to AAA students as well. So how are we supposed to write? Question is how to write audit / ROMM, audit risk / ROMM answers. So the correct approach is MTR. MTR, where M stands for materiality, T stands for treatment. So materiality you calculate on the basis of the threshold, and R stands for which risk do you think is here. So treatment is as per IFRS. So for example, there was a financial asset recognized. So you will talk about the amounts, materiality. You'll talk about the treatment as per IFRS 9. Then you'll talk about what is the possible risk, that maybe it is overstated or understated or misstated, right? So this is what we do in our audit risk or ROMM questions. Okay. Then how do you write procedures? That's also a very valid question. How to write good procedures? I've seen so many people confusing procedures with evidences. These are very two separate things, okay? They are not same at all. Procedures and evidence are totally separate. So what exactly is evidence and procedures difference? Let's understand it. Okay. So procedures, guys, is the work to be performed. Procedure is the work to be performed in the process of audit. In the process of audit, right? Then if I go forward, what is evidence? Evidence is the document collected by the auditor by performing the above procedure. So if the procedure is that you recalculated the depreciation to check its accuracy, the evidence will be that paper on which you recalculated the depreciation. So when I'm writing procedures, I should know why I am doing that certain procedures. So I am checking certain assertions. What are assertions? Assertions are promises made by the management, right? That's what I mean by assertion. Now, these promises, okay, these promises, if I talk about the promises made for statement of financial position, are usually, they are the REVAC, where we talk about that a particular asset and liability, there is an existence of rights and obligation. That's what R stands for. E stands for existence of asset and liability. V stands for valuation. A stands for accuracy. Then C stands for classification, right? So this is what I mean by REVAC. This is the assertion that I have for balance sheet. Similarly, I have assertions for statement of profit and loss, where I have occurrence that that particular income or expense has occurred. It is completely recorded. It is correctly classified. Okay. Its cutoff is correct. And it's accurate. And then lastly, it is correctly presented. Now to check all these assertions, I actually perform procedures. So if I say I'm recalculating depreciation, depreciation goes to P&L. So what I am checking by recalculating the depreciation, I'm checking the accuracy of that calculation. Let's suppose I say, go and do a physical inspection of the factory site. Why would you do a physical inspection of the factory site? Because ma'am, to see whether it exists or not. So when I say existence, that's actually a assertion. Yes, existence is an exertion here. It's an assertion of statement of financial position. So yes, that's what we have to do. We are checking the existence of that particular asset. Then, for example, you say, discuss with the management about their assumptions used to value an asset. So asset means balance sheet. So I'm talking about its valuation. I say check the ownership papers of an asset. I'm checking the rights and obligations. If I see that the procedure is check the or review the events after reporting period, that the sale has been correctly recorded for that financial year. Then I'm talking about cutoff. Sale is P&L, right? Reviewing the draft P&L. I'm checking the presentation. So that's what you are checking in every procedure, the assertions. So how do you write a good procedure? See, a good procedure will start from the work that you're doing. For example, a verb. Now, this verb can be that you discuss something, you recalculate something. I'm just giving you examples. This has to be very posh word, okay? You are reviewing something, you are inspecting something, investigating, inquire, etc., or obtain. So, work that you do, verb that you do, in that, on which document or asset or whatever, on what topic are you doing that work? So if I say recalculate depreciation, so what am I recalculating? I'm calculating depreciation. So what is the topic? So verb plus the topic. Then why are you doing it? What is the cause? Now the cause is to check some kind of assertion. So that I've already stated above. So which assertion are you checking in this particular regard? So that's what we have as a good procedure. So if you will miss out on this assertion, you will lose half a mark. So to get full marks one-on-one for that procedure part, make sure that you are writing it in the correct form I've just stated. Right? Okay. So this is what we have as audit procedures. Let's move on how to write good audit evidence. See, evidence is when I'm talking about a document. So if I said do physical inspection of a site to check the existence of that particular, to check the existence of that particular asset. So its evidence would be the photographic evidence. The photographic evidence of the factory site to ensure its existence. So that is something which is an evidence. How do you write an evidence? Similarly, if you say obtain board minutes, so that is a procedure, but its evidence will be copy of board minutes. Why do you want a copy of board minutes? Write the reason of it. That will complete your evidence point. So there is a slight difference between procedure and evidence. And if you confuse between them, you'll totally lose your full marks. So if you write a procedure instead of evidence or vice versa, you're not going to get any marks for it. Right? So that is basically our procedures and evidence part. So we have covered the planning stage of the audit with ethics, and we have covered the evidence and procedure stage of the audit. Now, next, what we have is review and reporting part of audit. Review and reporting part. So this is what we are going to do after 7 minutes of break. So let's take a break and get back to review and reporting part. Please have a glass of water or something so that this topic is very important for question number 3 so that we can cover it really well. Yes, guys, let's resume our session and let us discuss the review and reporting part of our syllabus. To begin with, let's talk about the review stage of audit. So what's there in the review stage of audit? That's when you've completed the procedures, you've collected the evidences, whichever was required. Okay. Now what happens in the review stage is that you are supposed to check the subsequent events. That's the first topic. In the review process, we have events after reporting period. So you all know from IS 10 that there are two types of events after reporting period. One is your adjusting event and another is your non-adjusting event. Now, as an auditor, what are you supposed to do? See, there is a timeline. That means when the audit started versus when the audit report was issued, right? So there is a time between these two things. So audit report was issued or audit report was signed. These are two different phenomena. So the audit, let's suppose, was completed on 30th of September. Now it was signed on 31st of December. It was signed on this date and it was issued on this date. So there is a timeline between these two dates. So what is the auditor's responsibility between these two dates? That's a question. So let us understand. Let's understand this. Between the reporting date and the date of audit report and the date of audit report being signed, the auditor has an active responsibility to look for such events, to identify any subsequent event which actually might impact the accounting treatment. You know, there can be such subsequent event which is so material that it will have an adjustment to the financial statement. So as an auditor, you have an active responsibility to identify such events between the two dates of audit report being signed and issued. Now, after the audit report is signed, this is where I've talked about reporting date and audit report being signed. So basically, I've talked about the timeline. Let's suppose the year ended on this 30th. Let's suppose it ended on 31st of July. The year end is on 31st of July. So reporting date versus the audit report signing date. Between these two dates, auditor has an active responsibility, right? But what is the auditor's responsibility between the date of 30 September to 31st December? So after the audit report is signed, but not yet issued, the auditor has a passive responsibility. Okay, it has a passive responsibility where if the management informs the auditor about a significant event, then the auditor is supposed to discuss, then the auditor is supposed to discuss and confirm its correct accounting treatment. Correct accounting treatment in the financial statements. In this case, the auditor might consider reissuing the audit report. So basically here your responsibility is passive. You don't work until the management informs you about such event. Now, once the financial statements are issued, okay, once the audit report is issued, auditor has no responsibility. But if there is such event which is brought to auditor's responsibility, like it is brought to auditor's notice, then only he will act on it. So you should know what do you do with events after reporting period. There are adjusting events. So you should know the accounting treatment of it. The adjusting events are adjusted retrospectively. Then there are non-adjusting events. So you have to see whether that event is material or not. If it is material, you will adjust it. If it is something which impacts the going concern, see, if a non-adjusting event is material, then you are supposed to disclose it. But if a non-adjusting event is impacting your going concern, then you are supposed to adjust it. That's the accounting treatment as per IS 10. Right? After this, after checking the events after reporting period, we also have to review the going concern. So for that, you need to understand the going concern rule as per IFRSs. So as per IS 1, guys, it is given to us in IS 1 that we are supposed to disclose the uncertainties regarding going concern. So in our financial statements, we are supposed to disclose uncertainties regarding going concern. Also, we are supposed to disclose if we are using breakup value basis. So if you are not a going concern, then make sure that you're using breakup value basis for the preparation of financial statements. That means you are making your financial statements, including the assets at NRV, net realizable value, right? So that's what we have to do. Now, guys, from audit perspective, if there are two situations, I will draw it out for you. There are two situations. One is that you are no more a going concern. Another situation is there is an uncertainty regarding going concern. As per the IFRS, if there is an uncertainty, I'm supposed to disclose it. If I'm not a going concern, then I'm supposed to disclose it plus make my financial statements on breakup value basis. Now, if the accounting treatment was correctly followed, what will you do in your audit report? What will be the impact on audit report? If you are no more a going concern and you've correctly disclosed and accounted for it, then this will be included in emphasis of matter paragraph in the audit report, because you're emphasizing on a rightly disclosed item, transaction, or account balance that yes, we are not actually we are just saying that this is correctly dealt with, but even though after being correctly dealt, I want to disclose it that in the audit report that this is something which is important for the investors to have a look at. That's what we are saying here, right? So emphasis of matter paragraph comes into the role here. Then uncertainty. But if the going concern, if it was wrong, and you have not correctly disclosed it, that means you have not correctly prepared the financial statements, the accounting treatment was incorrect. In that situation, what are you supposed to do? See, in that situation, you are supposed to, if it is incorrect going concern, you are supposed to make sure that you are issuing an adverse audit opinion, because it's a very important and a very material misstatement, highly material. Okay. And we are going to issue adverse audit opinion. I'll talk about what do I mean by adverse audit opinion. Once an adverse audit opinion is issued, I will also, okay, give it in the basis of opinion paragraph why I have issued adverse audit opinion. Now, if I talk about material uncertainty, if its accounting treatment was correct, then I will make an MURGC paragraph in the audit report. If its accounting treatment was incorrect, then I will issue a qualified opinion, because it's a material misstatement, but it is not pervasive. Here it was pervasive. So here it will be a qualified audit opinion. Okay. That's what I am supposed to do. Now, let us understand what are these terms that we have used: emphasis of matter, paragraph, adverse and qualified opinion, and MURGC. So for that, let's understand what are the audit report contents. So what is the content of audit report? So what goes into audit report? That's the question, right? So it's, first of all, it's a title of the report. Then you have addressee, to whom are you addressing it? So Taub Kora Reed is the friend's name. Then you give your opinion. Now this opinion can be unmodified opinion. That means everything is correct. Or it can be a qualified opinion. That means there is one single material misstatement. Or it can be adverse audit opinion, where you have pervasive and material misstatement. Or it can be disclaimer of opinion, where there is lack of information available or evidence is very lacking. Then you are going to give basis for audit opinion. Then you have CAM paragraph, which comes after basis of opinion. So in the original, I'm talking about the original audit report format. We have CAM paragraph here, key audit matter. Then we have other information paragraph, where we talk about the auditor's opinion on rest of the things apart from financial statements. Then we have the management's responsibilities. Okay, so responsibilities of the management. Then we have responsibilities of the auditor as well. So all these are the contents of audit report. Now, what are the types of audit opinion that we have? Types of audit opinion. See, the first type is qualified audit opinion, where when the misstatement is just material, not pervasive. Then adverse audit opinion, where the misstatement is material and pervasive. Material and pervasive. Then we have disclaimer of opinion, which is basically if there was a lack of evidence and there was a lack of evidence and it was a pervasive lack. Now we have used this term pervasive again and again. We all know what is material, but what is this term pervasive? What is a pervasive misstatement? So number one, if any misstatement is widespread in the financial statements, then yes, it is a pervasive misstatement. Something which is widespread in the financial statements, right? That is pervasive misstatement. Then the next part of it, what is pervasive misstatement? Yes, what is pervasive misstatement? Any misstatement which is a significant proportion, any misstatement which is a significant proportion of the profit / revenue / asset, right? So any misstatement which is a significant proportion of the important figures like revenue, assets, and profit. If it is a disclosure which was misstated, then it will be a pervasive misstatement if that disclosure was fundamental to users' understanding. So this is what I mean by pervasive misstatement, right? Now, once I understand what do I mean by pervasive and different types of audit opinion, let us talk about CAM paragraph, other information paragraph, and rest of the paragraphs. So let's talk about paragraphs which goes into the audit report. So first, let's talk about CAM paragraph, key audit matter. What is there in key audit matter paragraph? See, here you take out most significant matters out of the matters communicated to those charged with governance, right? Which are considered as highest risk areas based on auditor's judgment. So I will take that matter as CAM or key audit matter. For example, if there was a very risky area, for example, there was something which was significant during the process of audit, some disruption which happened during the process of audit, which you think is a key audit matter. So that is what you will disclose in the audit report. You place this after basis for opinion paragraph. And what do you write in CAM paragraph? You tell them what CAM are you talking about and why do you consider it as CAM? Why that matter is key audit matter for you? And how did you deal with it? How was it dealt with in audit? So how did you deal with it in the process of audit? That's what we are supposed to see. Then there is one more paragraph, which is emphasis of matter paragraph. So this is a positive paragraph. Why is it a positive paragraph? Because I am drawing the user's attention to something which was correctly recorded. So when I was talking about this treatment, when I said that this was correctly recorded, I said we will give an emphasis of matter paragraph, right? Here it was correctly recorded and we gave emphasis of matter paragraph. So I hope you're understanding when there is a correct disclosure, that's when I give emphasis of matter paragraph. So what is emphasis of matter paragraph? Drawing the user's attention, to correctly recorded or disclosed account balance transaction. So drawing the user's attention to this, which was correctly disclosed, and we don't talk about the wrong things here or misstatements here. Then we have other information paragraph. In other information paragraph, we talk about auditor's opinion on chairman's statement, let's suppose. So chairman's statement, we talk about the CEO statement, whether it is correct or not. We talk about like auditor's responsibility or inconsistency with regards to other information. See, other information paragraph and emphasis of matter paragraph. Emphasis of matter comes after CAM and other information also comes after CAM. But if there is an inconsistency, if there is an inconsistency in other information, then other information paragraph moves from after CAM to after basis for opinion. So you change its placement on the basis whether there was inconsistency in the other information or not. Right? Then you have other matter paragraph. What is other matter paragraph? For example, matters like previous year's financial statements were not audited. So such matters are actually disclosed in the audit report. Previous year's financial statement not audited. Or, opening balances. So stuff like that, other matters. regarding financial statements, which are not really related to accounting treatment, but basically just something important that you want to discuss with the readers of the auditor report. So other matter paragraph also comes after CAM. So if all the paragraphs are added, and let's talk about MURGC also. So where do you place MURGC paragraph? What is the placement of MURGC paragraph? It is after basis for opinion. So in MURGC paragraph, we basically talk about material uncertainties regarding going concern, so which are correctly disclosed in the financial statements. Again, it's a positive paragraph where we just draw the user's attention towards something which is correctly disclosed, right? So this is what I have as my auditor's report. Now, if every paragraph was added into the auditor's report, how would the actual name of our friend look like? Let's see. So what we have is the name of our friend is Taub Kora. This is the actual unmodified audit report. But if the name of the friend changes due to addition of anything, then the report is modified. So here, if the report is modified because you gave an adverse opinion, so the heading will change to adverse opinion. Then the name of the friend changes, right? So if I add all the paragraphs, MURGC will come here. Other information paragraph, if there's an inconsistency, will come here. Here you have emphasis of matter, other matter paragraph. So this will be the name. If the name of our friend changes, then we say that the audit report is modified. Right? So you can get a question in the exam for the critical appraisal of your audit report where maybe the placement of the paragraph is wrong, the wording is wrong, they've used short forms or they've used unprofessional words, they're blaming someone, naming someone. So all that stuff you're supposed to say. For example, in CAM, they've not written that why that particular matter is CAM. So you'll say this is missing. So all this is critical appraisal of audit report that might be there. Right. So this is what we have. As audit report. Okay. Are we clear till here? Are we all clear till here? Okay. Let's now move on to other assignments. That's kind of the last topic from AAA that I want to discuss with you, apart from the technical articles of sustainable assurance and the big data. So let us discuss other assignments. What kind of other assignments do we have? Let me just move on. Other assignments. See, these questions are generally asked to you in question number 3 of your paper, where generally we have various assignments like prospective financial information, where as an auditor you are asked or requested to actually review the prospective financial information. For example, cash flow forecast. So what are you supposed to do in that case? Is there something different? No. The only thing is that here you are not supposed to perform substantive testing. So you can get a question on writing procedures on cash flow forecast. So you will perform general procedures based upon the case study. Nobody is going to ask you to learn or mug up something in that. Okay. So you are just supposed to give the procedures, but make sure that those procedures are not substantive procedures. And they're basically like generally that you are reviewing something or you are doing analysis of something, like you're doing analytical procedures. So all that, or you are inquiring. So it's like you're not going to the site and visiting it or recalculating stuff. So that's what the essence of other assignment is, that we are not doing substantive testing, because substantive testing is done only in audit because we have to give reasonable assurance. Here we are just reviewing stuff and giving limited assurance. Then the second other assignment on the same note we have is due diligence. So due diligence is again when you want to acquire a company and audit firm is hired to review the financials of that target company. That is that target company genuine? Should we acquire it? Do we have the correct valuation of that target company? So that's what we actually see in the due diligence review. Okay, so you can get a question. For that, you must know that whenever we acquire a subsidiary, there are certain danger items, like which are not reported in the individual accounts of the subsidiary, but are recorded on the date of consolidation. So those danger items are like internally generated brands. So internally generated brands are not recorded in individual accounts of subsidiary, but are recorded in the consolidated accounts. Similarly, we have something like the contingent liability. So generally contingent liabilities are just disclosed, but on the date of acquisition, that is in the group account stage, it is actually recorded. So in the due diligence review, make sure you keep that in your mind and you have to make your procedures accordingly. So what you can get a question that why due diligence review is important, how it is going to help the company. See, with getting a due diligence review done, you can actually negotiate with the potential target better. So you know the fair value of the net assets of that company that you are planning to buy. So you will be able to value it better, right? So that's why it's important, right? Then we have the third kind of other assignment, which is forensic investigation. So in forensic investigation, you all must know that we are acting as an investigator. We are finding who is the perpetrator of fraud in a company. So we have to act in a very ethical way here because we have access to sensitive information of many people. So we should have that skill in us that we are able to find who was the perpetrator of fraud and what was the loss because of that fraud. So again, all these are dependent upon the case study. These are spontaneous topics. These are not direct theory questions. These are very spontaneous, just like audit risk, business risk, or procedures, right? So we have to do that as in when we see it in the exam. So prospective financial information, due diligence review, and forensic investigation. I hope I'm not forgetting out on anything. So these are the other assignments, and also make sure that for each of these other assignments, you know what procedures are to be performed before accepting the client. So when to accept, what are the acceptance procedures? The acceptance procedures are exactly same as audit. For all these assignments also, it is same as audit. Getting the background check, looking out for knowledge, training, experience, making sure that ethics are intact, all that stuff. So that's same as audit itself. Yes. Are we guys clear on it? Other assignments, review and reporting and other assignments? Fine. Now, finally, guys, we are coming to a very end of this webinar, which is related to sustainable reporting and big data. Okay. So I will discuss sustainable audit and assurance. I've already discussed it with my students, I think, in the last class. And I also told you to do certain questions. I gave you the name of those questions, uh, which were from the recent past papers, right? So we will discuss sustainability topic, that is ISA 5000, which is an exposure draft on sustainable reporting. And then we will discuss big data in brief. Okay. So let us take again a small break before the last lap of our session. So let's take a small break here. Then we are going to resume with sustainability. Let's resume, guys, with sustainable reporting. So for this topic, guys, you must be aware about sustainable reporting from SBR perspective. So that is something known as IFRS S1 and S2. There's a small short video on my channel, which you guys can go through once before you prepare for this topic. And honestly, this was being tested in the last attempt. And I don't think that it might be tested again, but we cannot take it for granted. So we are going to cover a part of it, okay? We are going to cover the gist of this topic, that is sustainable reporting. So this is basically related to sustainability. What do you mean by sustainability? See, sustainability means using resources in a judicious way, so that the resources are not just available today, but also for upcoming generations. Right? So that's what basically we have as a term sustainability. What do I mean by it? So you all should know the meaning of sustainability. Then the question comes that, okay, why do we have a separate topic out of it? Why do we have a separate topic out of it? Because recently, guys, IFRS S1 and S2 were introduced, where the ISB has made a proper standard on how you should report your sustainable information, like 6 types of capital, integrated capital. But how you should report it? What should be the format of reporting it so that there can be consistency and comparability? That is the part of SBR. So make sure you watch a video on that, which is available on my YouTube free of cost. Just watch that video just for knowledge, okay? Now, because we have certain amendment in accounting rules, so they say if now sustainable reporting is going to be the new trend, then of course we also need to do audit of sustainable reports. So audit of sustainable reports is equally required, right? Audit of sustainable reports is equally required. So for that, we have an exposure draft, which is International Standard on Sustainability Assurance 5000. It's still an exposure draft. It has still not come into reality. So what is the objective? What is the objective of sustainable assurance? I read this whole technical article with, if you remember, in the last live session for the students who are enrolled, we discussed the whole sustainability technical article. So we are just doing the revision of it right now. So the objective is generally to check if the sustainable report is true and fair or not. That's what you have to check. Because accountants have prepared these sustainable reports where they say that we have this intellectual capital, social capital, and financial capital, but who is going to guarantee it? They say we have donated this much money for the education of kids, but has that actually happened? How am I going to get to know about it? So we have to check whatever they're saying is actually true or not. And then finally, I have to give an opinion on it. I have to give a report on it. Now here I can give a reasonable assurance or I can give a limited assurance. That depends upon engagement to engagement. So which company wants what kind of assurance? Now usually, generally, it's very difficult to give reasonable assurance for sustainable assurance reports. It's very difficult to give reasonable assurance because again, it is something which is less justifiable, right? So this is what we have in objective of sustainable assurance. Now, whenever we are doing audit, it's like you're auditing sustainable reports. You need the concept of materiality. How do you define materiality for sustainable reporting? You bifurcate it. You have a concept of double materiality here, where you say that, okay, double materiality means you see whether by nature you see whether it is material to the organization, okay, the client, or whether it is material to outside world. Because if you say I've generated 1,000 jobs, that's what's written in your sustainable report, it will be material to the organization themselves because it will lead to like expense to the business. If you have generated jobs, it will also increase your productivity. So it will be material to you as a company, but it will also be material to the outside world. So double materiality is when I think about the organization as well as the outside world. Then I use this materiality in the planning stage of my reporting or my audit that I'm doing on sustainable report. I check what are the risks here. So what are the risky areas? What are the important claims that are being made in the sustainable report? Then I try to collect evidence. Now, as an auditor, for this purpose, collecting evidence is very difficult because see, these are very qualitative things which are involving subjectivity. They involve judgment, right? These are not facts. So these are involving subjectivity, judgments, relativity. So it's very difficult to obtain sufficient and appropriate audit evidence, right? Now, here, what is important and something that can be tested is like what ethics you have to follow in this sustainable assurance. Like when you're giving assurance on sustainable reporting, what ethics as an auditor are you supposed to follow? See, generally what people are doing is they are doing greenwashing. You know what the term greenwashing? Everyone is trying to depict themselves as a very good wisher or well wisher of the environment, of the society as a whole, and doing everything good for the world. So we are greenwashing the stuff, right? Now, in this greenwashing part, what happens is there's a possibility that auditor might end up actually becoming part of it. And auditor might take it as a self-interest because see, auditor takes the audit of financial statement seriously because it has some liabilities, it has some facts, it has some calculations. But for this sustainable report, the auditor might consider it as a useless assignment that he is taken up for extra money. So his fee will increase because he's also auditing the sustainable report, right? So he might take it as a self-interest, right? So there is also a risk that people are doing fraud in this sustainable report by stating or overstating their concerns for the environment and what they're doing for the society and the environment, right? So there is a lot of scope of manipulation. And from the perspective of auditor also, there's a scope of manipulation, and nobody really would be able to question the auditor on it because this is a very vague area. So overall, this sustainable assurance is a very vague area which has subjectivity, which has judgment, which has a lot of challenges. So it's very difficult for us to get to a conclusion in this sustainable assurance. So what kind of question can you expect in the exam? I requested, I'm going to give you the name of the questions. So we have question Oak and Burton, which are from the recent past papers, okay? From, I believe, you can check the June and the September paper, one of those. So you can check out the question number 2 of these papers, which are dealing with this. So there they have asked you about the concept of double materiality. Then they've asked you about ethical issues which the auditor might face regarding sustainable assurance, right? So these are the questions which you are supposed to do for this topic. I've just covered the gist of it. Again, for sustainability, I've just covered a gist because I believe even if it comes up, it will come out as a very less relevant part of your paper. Okay, but we can't leave it. So we are just doing a gist of it. So if possible, do go through the technical article. If you are my student, you've already gone through the technical article with me. If you are not, go through the technical article on the ACCA website. Lastly, there's a concept of big data from which you can get a question of disadvantages of big data. So big data or data analytics, where we use the data to analyze few things, right? We use the concept of analysis, right, for the data. So for example, big data is basically, if you say something today in front of your phone, the moment you will see an advertisement on Instagram related to it. So whatever you Google now, you will start seeing reels on that. So that's big data. Like, okay, your data is stored somewhere and the companies and the businesses are using your data to show you certain, things. So what are the advantages of big data? How can you use it in the process of audit? What are the advantages of big data? See, number one, it is going to save your time. So if you use big data, you structure it, and then you use big data for your audit process, it will save your time. It will give you better results. So of course, it will give you better results in the process of audit, because you will have more information to you. So you can use computer assisted audit techniques to structure this big data and draw analysis, right? So you can draw analysis on the big data. Yes. So since it is based on technology, it will reduce the human errors. Reduce human errors. So these are the advantages of big data. But there are certain disadvantages as well. So what are the disadvantages of relying on big data? See, number one disadvantage of using technology in the process of audit is that your data can be leaked. So data leakage. Second disadvantage is that your data can be manipulated, because it's not manually gathered, right? It's something which is there in the system and you're structuring it on the basis of your things which are there in your hand. It can cost you a huge chunk, right? And then it can also lead to NOCLAR. How it can lead to NOCLAR? Because of course, if you end up leaking the data, or if you end up not following the IT rules, then of course it can lead to non-compliance with laws and regulations, which is wrong for your company, which can impact your going concern as well. So this is basically what I have in my big data analysis and sustainable assurance. So if you want, you can read the technical articles of both these topics. These are like extra current issues kind of a thing. Or if you understood this, that's also sufficient. Yes. So this is what I had to cover in this session. Now, let me give you certain suggestions for the remaining days, which are very less. My suggestions for the remaining days, guys, for AAA. I hope you all have covered the Super 20 questions and all that stuff. You must go through the pre-mock of June 2025. If you have not written any mock yet, write this one as your mock. Okay, that's the first thing. For my students, it's an announcement for you as well. On 31st of May, I'm going to have a live session just for my students on the portal of TG Profs. We are going to have a session at 8 p.m. IST, where we are going to discuss the pre-mock. Okay, you can do that pre-mock until then, and we can meet online and discuss the pre-mock. If you want to not wait till 31st May, which is quite justifiable. So you guys can actually watch the ACCA debrief, which is already available. Then make sure that you write it in timed environment, because AAA is something which will create time management problems. Okay, so make sure you've written it in proper time pressure, like proper study pressure. So 3 hours, 15 minutes, direct you write this AAA paper. Third thing, for the next days, please revise your concepts. Now stop doing the questions. If you've already done like 40 to 50 questions, if you've already done that number of questions, stop doing questions now, just revise your concepts. So revision of concepts means your notes. Okay, so whichever notes you have used for your preparation, please reread them. That's basically the strategy to pass a theoretical paper. More you will read, more you will retain, better you will write in the exam. Okay, so please read that. All the areas are important when you're reading the notes, okay? So you're going to go through all the areas, whether it is quality management, your liability, your fraud, NOCLAR, acceptance procedures, professional skepticism. Just have a run through of your notes. Okay, so you must have highlighted some things here and there. Revise that part. Then, of course, today's grand revision was your step towards success. So these are the three things that you have to short do. If you have not yet revised, please go through the grand revision of SBR for IFRSs. Yesterday's session you can check out, or before that, any quarters session you can check out for the IFRSs, right? So these are the 4 things that I expect you to do before your exam minimum. I'm assuming here you've given the mocks that were the mock that was conducted, mock 1, right? I'm assuming that you've done super 20 questions. If you have not done super 20, at least you've done 40 questions from your whatever source you have followed, right? So here, these are the remaining 3 days that I would suggest to you, right? So that's it, guys. Okay, that's it that I wanted to discuss with you. I know this session is pretty late, but again, this session is to be consumed not just for pre-mock. Like pre-mock will take us like 45 minutes or so. We are going to discuss your doubts. Whatever you want to discuss with me in the live class with all the students of AAA batch, we can meet live and discuss. Join it only if you're free. If you're not free, no problem at all. Don't join the session. Watch the recorded debrief from ACCA and it will be sufficient. So that's it, guys. Thank you for joining in live in this grand revision. And I'm really sorry if I would have missed any of your doubts because I see less of the screen while teaching, because it's not Zoom. So not really, like I'm not looking at the chat box always. So thank you so much, guys. All the best to all of you. May God bless you and may you all pass with flying colors. I will be adding this word as your notes in the description box of this video. Thank you once again and God bless you. I hope to get positive news from all of you once the results are out. Do your best. Don't be anxious. Fight back your negative thinking. And I'm sure you will get the best outcome. Thank you. Good night.